Oops. All right. Let me fix this screen. That didn't work. There we go. That's better. Sorry about the mess on my table today. Oh, well, let's just get it started. So, today I wanted to talk about the FIRE movement. And I have nothing against it, but I did some basic math. And I think it will be interesting to you guys to see how there is a basically double as fast or twice as fast. There is a way to retire and be financially free. You know, the FIRE movement stands for financial independence, retire early. There is a way to do this faster. And there's a way to do this not only faster, there's a way to do this so that it grows your income after you achieve financial independence, retire early, FIRE, right? And that is, drum roll, big surprise, real estate investing. And I'm going to do some basic math and I'll teach you exactly how to look at it side by side really quick. It's going to be a very quick example and you're probably going to poke a bunch of holes in it. And I'm welcome to that because this is not an exhaustive analysis, but I do want to give a simple side-by-side comparison from one perspective just so you see where I'm coming from on this. All right, so without further ado, let's kick it. Now, when you're thinking about, when traditionally people talk about FIRE, they talk about the 4% rule to achieve financial independence, which means that you need to have a certain amount of money saved up, however you got there, stocks, just savings, whatever, right? Maybe a 401k, Roth IRA if you want to wait till you're 59 and a half or 65. But if you want to get there early, right, retire early, you need to be saving in something that you can pull out maybe without that penalty, or you're just okay with a tax penalty, whatever. So here you are, you're saving up money, right? You're taking advantage of compound interest and you're being smart with your stocks investing. You're not like pulling it out when the stock market is down because then you're at a loss. You're actually contributing more when the stock is down that you trust in because then you're going to be able to buy more of it. So when it rides back up, you make more, right? That's the typical philosophy, right? You're a smart stock market investor essentially. Most of the time. There's other approaches. You can blend in whole life insurance. You can blend in other types of things to kind of hedge losses down the road. But for the most part, traditionally, let's just talk about what I have experienced when I talk to people that have achieved FIRE, which is awesome. Like, good on you. This is not dogging that at all. But again, the point of this video is to show a faster way, an alternative way. But that, just to set the playing field, that is the typical way to get there. It's the 4% rule, right? So you need to get that amount of money so that you can then invest it into something that's very like a bond or something that is, or a high yield savings account that is producing you about 4% returns every single year. So that then you can, without too much risk at all, basically live off of the 4% from what you've saved up, okay? So if you save up $1 million, guess what? 4% is $40,000. If you save up $2 million, 4% is $80,000 and so on. So you decide how much you want to live off of every single year. If it's $80,000, then you need to save up $2 million, right? Okay, so we laid that out there. Okay. Now, if you want to achieve that with real estate, here's an example. Okay, let's think about it as like a bill. Okay, so because I saw a pretty cool example on Twitter, and I want to go with this because I did my own numbers on it. Let's say there's a bill you want to pay off because that's how you calculate your financial freedom number, right? That's how you arrived at your 40, 80, 120, however much you need every year. You counted up all your expenses. Well, let's say one of those expenses is a bill that's $200. I don't know, maybe that's your electricity bill, right? And if it's $200 every single month, what is that annually? It's $2,400. Cool. All right. So what do you need to have saved up to be able to pay off that $2,400 every single year if you're getting 4% return? Well, you're going to need to have $60,000 because you basically divide it by 0.04 or you multiply it by 25, whatever. Point is, $2,400 to have that paid off every single year, you need $60,000 saved up. That's bringing you that 4%. Pretty simple. Now, what would you need to do in a conservative example in real estate to be able to pay off that same amount of expense every single year? You would need a rental property that produces $2,400 every single year. Well, what would that look like? Well, it'd probably be like $150,000 rental property in the middle of America, maybe outside of Memphis, outside of Indianapolis. I'm just making some stuff up real quick just for the sake of this example. And let's say it's a nice little 3-bedroom, 2-bath. Actually, my first turnkey was, I believe, $160,000, just around that amount. And then it was actually producing me more than $150, or sorry, let's just do the math. So this $150,000 turnkey property, you're gonna need about $30,000 down payment, okay? Plus some closing costs, but let's just keep the math simple. If it's a 20% down payment, you used to be able to do conventional loans. We might be getting back to that soon. You're gonna do a debt service coverage ratio loan. We can help you all with that. I'm gonna post a link up here. But point is, you can buy these as rental properties that you don't have to live in, sometimes as low as 15% down. But let's just pretend it's 20%, and I'm going to forego the closing costs, but that's going to be a few $1,000s now as well. I just want to make the math simple. So it's $30,000, right? So $30,000 for a $150,000 investment property, rental property, that gets you 8% return. What is 8% on $30,000? Well, 8% just so happens to also be $2,400 every single year, or $200 a month. Okay, and 8% cash on, and this is cash on cash. I mean, the rents come in, and then you subtract the principal, interest, taxes, and insurance for the mortgage. Then you subtract a property manager, so you don't have to deal with it that much. And then also maintenance, vacancies, and then even reserves, right? Like this thing is, you have accounted for all the expenses, and now you're still netting in your pocket the $200 every single month, or $2,400 every year, okay, to cover that bill, whatever that bill is. The sneaky thing with bills are, though, is that bills tend to go up over time. Like my car insurance bill, with Geico just went up twice because of inflation, and the interest rate market is crazy, and there's more risk in the insurance market now. Like, point is, my car insurance, without any changes to my record, went up double over the last year, basically. And so if you have bills, what do you do about inflation when those bills go up, right? So that's the tricky part. So that's one thing I want to compare. But let me just make sure I foot stomp what I just showed you a second ago. I showed you that a $30,000 investment can do the same thing as a $60,000 investment, right? If you save up $60,000 and you put it into a high yield savings account that gives you that 4% return, versus saving up only $30,000, which you should, logically be able to get to that faster, twice as fast, in fact, you can produce the same results. The beautiful thing about the rental property, though, is that as inflation happens, rents increase as well. Okay, so obviously the expenses from your rental income will also increase a little bit, but they increase based off of percentages of each one of those small expenses. Your rent will go up based off of its price, which rent is the largest number in your calculations when you analyze a property, right? The rent is the top number. And so most of the rent trickles down even as those expenses go up a little bit. And so you really are capturing the inflation a lot better. You're basically beating inflation, okay, from a monthly income standpoint. And so when your bills go up in your life, when you're retired, your properties, if you bought them in good markets where there's stable job growth and the supply and demand is where it needs to be, then your properties are going to be raising their rents, and your income from those properties is going to be going up as well, and it's going to be matching or if not beating significantly, your expenses as they go up in life, which is awesome. Okay, so there's just one example of how, you can get to the same number, right? That monthly income you want to be making so that you can retire early twice as fast. And also how, after you reach that number, how you can stay in a safe position and not find yourself having to find another job years down the road when you realize that inflation killed your plan. Okay, so there's that. Now, let's talk about what often happens when I talk to anybody about this strategy. They're like, well, what about the interest that you're paying to the bank and to the government or whatever? Like, goodness gracious. When I look at the calculator on how much a mortgage costs me, like, That's just like hundreds of thousands of dollars in interest. I don't want to pay interest that much to somebody else. That's just throwing money to the wind. Yes and no. If you think about any kind of businesses have expenses. It's just an expense. Personally, do you think, well, not personally, look at Apple. It's like $1 trillion, $2 trillion company, whatever. Can you imagine what their expenses are? Do you think they care? Yes, they do. But relative to how much money they're making, they understand that they need to have those expenses to be able to profit as much as they're profiting. It is just a part of the business. In this case, don't look at the interest as something terrible. It's just how the business runs. You need to pay interest to somebody for being able to leverage that debt. And the reality is debt is one of the most beautiful wealth builders of all time if it's good debt, especially with real estate. And here's a little bit of analogy. I saw this on Twitter too, and I loved it. All right, a Coke can of Coke. You want to go buy some Coke, right? 30 years ago was a few cents. I think maybe 5, 10 cents. Now, what is it? $2, $3 at a gas station? Guess what it's going to be in 30 years? It's probably going to be over 10. Okay? So think about it the same way with real estate. As the dollar loses its value, right? If the actual value of the property does not change, then you're going to need more of those dollars to trade over to buy that property. So what you can do with a mortgage is actually lock in the price of that home and beat inflation in another way. You lock in the price and how much you have to pay for that home on a monthly basis because your principal and interest combined payment does not change for 30 years on a fixed interest rate, right? Mortgage. You'll be able to hold on to that property for the 30 years, for example, if it's a 30-year term, pay it off. And now, I mean, again, stop looking at the interest rate you paid, the interest that you paid to the bank or whoever the lender was over those 30 years. And now that property is probably double, triple, quadruple what it was worth when you bought it, right? If you can think 30 years down the road, in a perfect world where you decided to buy and hold that, right, for 30 years. And now, now it's quadrupled in value. And guess what? Somebody else, not you, paid that off. Do you see what I'm saying here? Not only was your income increasing every single year because the rents were increasing, but also it's massively appreciated over time. And somebody else was the one that paid it off for you, not you, your tenants. They were paying you the rent, and then you turned around and just paid the mortgage off as an expense. They were the ones contributing the money to make that happen, not you. I mean, guys, what else can I say? And another thing about just real estate in general is that typically if you get to this point where you start owning a few properties, you start getting the bug, right? And you start wanting to move your money faster, and you realize how money can work for you instead of having it be something that you save away and you're worried about spending. Because here's another thing that I don't always get a perfect answer to, and some people have their own solutions, but what if you have money saved up and that's the money that's supposed to be maintaining your livelihood because of the 4% interest rate is bringing you? What are you going to do if you have a big expense in your life? Now, I read a couple of, one solution was have a whole life policy or have some kind of life insurance policy where you can borrow against the cash value. It's just a part of what you're saving when you're on your road to fire. And then you basically, it's less expensive to borrow that money from the cash value to cover the large expense, and then to kill the nest egg that's bringing you the 4% income. So, and I thought that was pretty cool. That's a good way to hedge against that. But some people hate whole life insurance, so I'm not going to harp on that too much. But anyway, I just want to say there are solutions. Another solution is just save up way more than you need. That's cool too. That's awesome. If you can do it. I can't remember the latest statistic, but the average American definitely doesn't end up saving up as much as they actually planned. And I'm not saying that you're going to fail at that. No. If you're watching this video, you're like, I'm going to do fire, as they say in Ukraine, I'll give the flag to you. Like, I want you to achieve that. Absolutely. The point of this video is just to give you an alternative example of how real estate can actually help you retire sooner and help you maintain the lifestyle you want after you reach that quote unquote retirement age. Even though we all know that retirement doesn't mean you're just going to sit on your butt. You're probably going to go do cool things and maybe even work still just because you love it. So that's the point of this video. Let me know if you have any other opinions or thoughts on that. I'd love to hear them. I'm open to it. I'm not saying one strategy is better than the other. I'm just saying I wanted to talk about the example there, that analogy of the two. So anyways, Mark Jancic is out. Hopefully you guys are having a great day. I believe this is day 12 of my vlog. See you later. Bye.